America's emergency oil tank is 19 million barrels away from empty. At the exact same moment, chip stocks are ripping at a pace the market has only seen twice before, 1999 and the year the dot-com bubble burst. And here's the part almost nobody is talking about. The cost of protecting against a stock market crash just hit the lowest level ever recorded. Nobody is wearing a seatbelt. Tonight, the desk traces 3 fault lines running under this rally, and the one level on the S&P that tells you which way it breaks. Start with the tank. The Strategic Petroleum Reserve is the United States emergency stockpile of crude, the buffer that gets drained when supply gets cut off. Reuters has tracked it sitting near 40-year lows all year, and by the desk's math, it now sits roughly 19 million barrels above its minimum operating level. Below that line, the reserve can't physically pump at full rate. 19 million barrels sounds like a lot. It's about 1 day of global consumption. That is the entire cushion left if flows through the Strait of Hormuz get disrupted again. Now set that against the diplomacy. The president said this week that Iran has been calling and wants a deal. Markets rallied on the comment. But prediction markets tell a colder story. The odds of an actual US-Iran nuclear agreement this year are priced near record lows, around 1 in 3. So the base the market is standing on is no deal, no buffer, and headlines that can land at any hour. Hold that thought, because fault line number 2 is where the money is actually going.
There is a generational handoff in cash flow happening right now, out of the companies that make chips into the companies that buy them for data centers. And this week is the loudest moment of that handoff yet. SK Hynix, the world's second largest memory chip maker, starts trading on the NASDAQ tomorrow under the ticker SKHY. CNBC reports the offering is set to raise close to $29 billion, the largest listing of its kind on record, bigger than Alibaba's New York debut, bigger than Saudi Aramco. Institutional orders are reported at more than 7 times the shares available. That is not quiet institutional interest. That is a stampede. Same morning, Micron, ticker MU, announced up to $3 billion of immediate investment in the U.S. chip supply chain, part of a plan that now totals more than $250 billion through 2035, anchored by a New York campus set to become the biggest chip fabrication complex this country has ever built. The stock spiked as much as 9% on the news before settling up more than 4%, and that single move did more to lick the tape than anything else on the day. Step back and look at what those 2 headlines mean together. The memory makers and the foundries are harvesting record free cash flow, and instead of banking it, they are pouring it into capacity at a pace the industry has never attempted. Micron's number alone, $250 billion through 2035, rivals what entire nations spend on infrastructure. And the buyers on the other side, the hyperscale data center builders, keep absorbing every wafer that ships. That's why this is a transfer and not a bubble in the accounting sense. Real cash moving from real balance sheets into real construction. The bubble question lives somewhere else, in the price the market is paying to own a piece of it. So the momentum is real. The capital is real. The demand for AI compute is real. Here's what else is real. The semiconductor index is up roughly 50% in just 3 months. And market statisticians circulating the comparison this week point out that surges of this speed have clustered in exactly 2 prior eras. In 1999, chips went vertical and then doubled again the following year. In 2000, they went vertical, and then the dot-com bubble burst. Same signal, opposite endings. Which brings us to the 3rd fault line, the one that decides how much damage a wrong answer does. The price of crash insurance on the S&P 500, what the options market calls put-call skew, just printed 0.71. That is the cheapest it has ever been. In plain English, this measures how much investors pay for downside protection versus upside bets. At a record low, essentially nobody is paying for protection. Every passenger in this market is unbelted. And the options market is whispering something else too. The NASDAQ 100 Volatility Index, the VXN, is sitting around 27, while the regular VIX sits near 16. That gap, a ratio of about 1.7, is the widest since 2002.
The VXN has also held above 20 for 5 straight months, the longest streak since the 2022 bear market.
Translation: the market is pricing violent swings, specifically in tech, while the broader tape looks calm as a lake. That divergence between calm and stress is exactly what the desk watches, and there's one more version of it from yesterday you should see. Yesterday, the equal weight S&P, ticker RSP, fell more than 1%, while the Nasdaq 100 gained. That's rare. The last cluster of days like it came during the 2020 recovery. Think about what that split actually means. The average stock in the index went down, while a handful of mega-cap tech names carried the whole tape higher. The market's legs and the market's headline are walking in opposite directions. Historically, the pattern chops sideways for 2 or 3 days, then resolves higher. The 2-month average return after these signals runs near 7%, and it strengthens further out at 3 months. So the history is bullish, but the path there is usually ugly, and the short-term average return right after the signal is actually negative. Bullish destination, nauseating road, which is why the levels matter more than usual right now. Here is the desk's map on the S&P, using SPY. The index sits about 1% off its highs, and today it broke above the downtrend that has capped it for weeks. Overhead, the ceiling is 752. SPY rejected there today, and the high from Monday's breakout attempt sits at almost exactly the same spot. Clear 752 and hold it, and the breakout has room.
Below, 750 is the floor the bulls just reclaimed. Lose 749 to 750, and the short-term read flips bearish fast. The deeper support shelf is 739 to 740, which held on the last flush. 3 numbers, 752 above, 750 at your feet, 740 below. That's the whole battlefield. One calendar item before the desk's watch list. Delta Airlines reports before the open tomorrow. Watch it for one thing: fuel. With oil moving on every Iran headline and the reserve cushion nearly gone, Delta is the first big company to tell us whether energy costs are actually biting. Its guidance will echo far beyond airlines. And Delta is only the doorman. Earnings season ramps hard from here. The pattern to watch as the reports roll in: any company that touches fuel, freight, or the consumer's gas tank is now a live read on the oil story. And any company selling into the data center build-out is a live read on the chip story. The first Pepsi-style warning was this morning. Count how many more follow. That count is the earnings season scoreboard for tonight's 3 fault lines. Now the watch list. 5 names, each tied to one of tonight's fault lines. These are levels to watch, not recommendations. First, Pepsi, ticker PEP. It reported this morning and fell around 3%, and the reason connects straight to the oil story. Management flagged that high gas prices and inflation are squeezing snack purchases. The chart has one shelf that matters: 135. The June 30th flush stopped just under it. Today's low printed near 134.70. If 135 gives way in the coming days, the breakdown has news behind it. If it holds, that's the bounce spot. Second, the other side of the energy trade, ENPH, ticker ENPH. Down roughly 40% from its late May high, but it popped over 4% today, and the logic is simple. If oil supply is the problem, money eventually looks at energy that doesn't ship through a strait. The longer trend of higher lows is still intact. A bounce off that trend is the tell. Third, the fear trade. First Majestic Silver, ticker AG. Silver has been cut in half from its highs, but today it did something notable. It punched back above the $60 line, up nearly 4% on the day. Gold firm, too. Remember the setup here. At the start of this year, metals were the hottest trade on the board. Miners flying, both metals ripping, and that entire crowd has since rotated out into chips and AI. So the positioning is now the mirror image of the euphoria next door. Crowded out of metals, crowded into semis. If crash protection is the cheapest it has ever been, and a supply shock is one headline away, that rotation can reverse fast, and reversals out of empty positioning are the violent kind. AG jumped more than 8% today, still down nearly half from its high, and its downtrend line is the trigger. A break of it with silver holding above 60 is the desk's cue that safe haven money is genuinely moving, not just bouncing. Fourth, the one that ignores all of this, Alibaba, ticker BABA. It barely correlates with the S&P, which is worth something in a week like this.
Analysts are projecting a jump in cloud revenue near 45% into earnings, and the stock just got a favorable U.S. court ruling on the side. In a tape hostage to Iran headlines, a strong chart that doesn't care about Iran headlines earns a slot. And fifth, the pure momentum pair. One line each, valid only if the level actually breaks. OKLO, OKLO, tagged 50 and a quarter today and backed off. Through it, watch up. The nuclear names are waking up with the energy story. Hims and Hers, HIMS, has a double bottom near 35.25, and today's low touched it almost to the penny. Under it, watch down. No break, no trade. These names move violently. Position size like you know that. One more print from the options tape before we close the loop. Unusual activity trackers flagged a $2.45 million bullish call spread in Hynix Pharmaceuticals, ticker TNXP, targeting the 10 strike into an August 10th earnings report, structured to roughly double if it works. Biotech has been running as a group, and this stock's history is a cliff face in both directions. Past rips near 900%, past givebacks near 95%. The desk's only read: someone with real money wants a fast move inside 6 weeks, and $12 is the base that has to hold for the setup to live. Before the close, here's tomorrow's session, sketched as 3 scenarios, so none of it surprises you.
Scenario 1, the breakout. Delta's fuel commentary comes in benign. The SK Hynix debut prices strong and trades up, and SPY punches through 752 and holds it. In that world, the chase is on. The 1999 version of the chip precedent stays alive, and the next resistance is simply the old high, about 1% up. Scenario 2, the rejection. SPY tags 752 again, fails again. That would be the 3rd rejection at the same ceiling, and drifts back into the 750 zone. That's the chop scenario, and it's the most common outcome after an equal weight divergence like yesterday's. Nothing is broken unless 749 goes. Scenario 3, the tripwire. An Iran headline or an ugly delta print knocks SPY under 749 in the first hour. Then the map inverts. 740 becomes the magnet. The record low crash protection becomes the accelerant. Because a market with no hedges doesn't sell politely, it sells all at once. One number decides which movie you're in, and you'll know within the first 90 minutes of the session. So pull the 3 fault lines back together. The oil buffer is 1 day of global demand from its floor, with deal odds near record lows. The chip trade just matched its 2 most extreme precedents in history. One kept doubling, one detonated. And crash insurance has never been cheaper, which means the market has never been positioned for the good outcome this completely. None of that says the rally ends tomorrow. It says the rally is unhedged. Watch 752 on SPY for the green light, 750 as the tripwire, 740 as the last shelf. Watch Delta at the open for the first real fuel cost verdict. And watch that SK Hynix debut. $29 billion of fresh conviction meets a tape with no seatbelts. That's the desk's read for tonight. None of this is financial advice. Levels to watch, not calls to action. Protect your capital, size with respect, and we'll see you at the next brief.